A review by the central bank shows Singapore's financial system able to weather heightened geopolitical uncertainties in the year ahead. Stress test by the Monetary Authority of Singapore looks at how the system will fare in extreme simulated economic scenarios. MAS looked at companies, households and financial institutions. The central bank says these groups need to stay vigilant on global developments. Trade tensions and ongoing conflicts in the Middle East and Ukraine are amongst global uncertainties. MAS says these could trigger larger and more frequent supply disruptions. They may also push up consumer prices. On the business front, most local firms were assessed as having earned enough to pay their debt. That's amid a high interest rate environment over the past year. Firms relying on external trade or those that are capital intensive could be more vulnerable. They could face potential inflationary shocks or trade frictions. Banks were also assessed to have sufficient buffers in place to withstand shocks. But their performance could take a hit if interest rates should stay high, making it difficult for borrowers to settle their debts. MS says a slower global economic growth and escalating trade tensions could also have a negative impact. When it comes to households, stress tests reveal that more than 90% are able to continue paying their mortgages. But those with larger mortgages could be at risk. The review also found that while household debt increased in the past year, the impact was softened by wage growth and financial assets. MAS says borrowers should manage and plan their finances carefully.
The stress test is about basically cash in hand the consumers may have, deriving from their current income. It doesn't take into account the wealth they may have in their CPF retirement account or even the equity they may have stored in their house. So clearly, if we account for all these factors, actually all consumers in Singapore are well buffered against severe stress scenarios.
And Professor Sumit Agarwal joins me now for more on this story. Professor, we've just outlined the risks that household, businesses, as well as financial institutions here in Singapore have had to face this year. Insofar as one cannot predict things, for example, the direction of conflict in Ukraine or in the Middle East next year, do you see these risks getting worse, where they can be managed, or perhaps ameliorating in some instances?
I mean, I see positivity. I've already seen what happened, the ceasefire deal between Hezbollah and Israel. That's a positive development on this front. We know Trump has vowed to negotiate the settlement between Ukraine and Russia. I'm not sure it'll be that quick, that when he steps in, it will be done. But there will be positive things in those directions. There could be other things that can crop up. I mean, look, we cannot solve the geopolitical problems. Some things could erupt in China or elsewhere. So I think the important thing is Singapore is resilient and has been resilient to these kind of shocks in the past and in the future. I mean, the key point is, if you look at COVID, Singapore came out very strong during COVID, whereas all the big countries could not manage it.
All right, Professor, while some things cannot be predicted, one thing we do know, for example, the IMF has come out warning against increasing fiscal debt. Now, Singapore may be strong on its own, but as part of a global trade system and economic system as well. So if debt is not managed on many large economies, can Singapore withstand this on its own front?
Even there, if you look at sector by sector, let's think about the household sector. Because the government or MAS has imposed very strict macroprudential policies like LTV requirements, DTI requirements on mortgage loans, the consumer balance sheet is very good. If you look at the corporate balance sheet, it's also very healthy because, again, they require them to have good enough income or profitability. Secondly, we have seen the income growth or profit growth in Singapore to be quite high. unemployment rates to be low, interest rates are dropping. So I think of them as the various sectors of the economy doing very well. Obviously, Singapore as a government doesn't have any debt. They don't run a debt. They have huge surpluses.
And of course, MAS, as you just mentioned, they're prudent macro policies, and any central bank at any point has to balance all its different tools in its toolbox to manage what's happening in a country's economy. Do you see MAS tweaking in any way its policies to manage expected risks in the year ahead?
Yes, possibly. I mean, look, we cannot foresee all the risks. But I can imagine if inflation was going to turn around and we could see some inflationary environment, MAS can easily come down and impose some other restrictions, because increased inflation would increase interest rates, and that would make debt service burden of the consumers and corporates difficult. Right now, actually, I see the reverse. Inflation is going down, so interest rates are going down on both the consumer balance sheet and the corporate balance sheet. So I don't see, I mean, it's a quick enough decision for MAS to make to adjust to these changes.
A final question on consumer consumption habits. Given this rather positive assessment, but still a balanced one, do you see those changing more consumption or more saving in terms of Singapore households?
I expect more consumption because now the debt service burden of the Singaporeans towards mortgage debt has gone down, which means that has freed up their balance sheet so they can have more time or more money to go out and spend on luxury or dinners and things like that. That is also good for the economy because consumption drives the GDP. Having said that, I would advocate that, look, we should all be prudent for the medium term because we have to worry about unforeseeable shocks that could come about from various sectors, health or geopolitics.
Oh, those are the unknowns. Professor Sumit Agarwal from the NUS Business School. Thanks for joining us this evening.